Okay. Hi guys, let's go over some calculations related to accounting for financial management. So specifically, we're gonna estimate free cash flows and other related performance matrices for this company using this spreadsheet. Given information in the spreadsheet, given the financial information in the spreadsheet of this company. So the context is that this company has undergone a major expansion. It doesn't have to be an event like this, but in this case, this company has undergone a major expansion in 2017, 18 compared to 2018. So we're going to try to understand the implication of this expansion on investors, right? How they fared, how they performed in terms of um, adding wealth to the investors. So the financial statements and other kind of information that we need are given here, and we need to do some calculations of using those information below down here. So the first thing I would do is, to make my life easier, is to split the screen view so that I can move both this part of the screen independently. So I'll select on this row and say, all right, view split. All right, so if I do that, so I can move this part and this part independently. So when I make a reference to the sales, it's going to be easier. Okay, so the first thing we're going to calculate is it's not directly related to calculation of free cash flow, but this is something. This is a kind of a matrix a lot of people will care about. Would be something called a net cash flow. This is based on the idea that net income in the income statement is derived on an accrual basis. For example, non-cash income and expenses are also included in net income. So what is the net net income if we kind of ignore non-cash income and expenditure? So mainly it's the non-cash expenditure of depreciation that impacts the income statement much more. So so that's what we're going to do as a quick calculation first. What is the net cash flow of this company? So net cash flow is just income, net income plus depreciation. It could have also amortization if there are amortizations in there, right? In over there. So I'm just going to itemize some of those things. All right. So okay. So I split the view for a reason. So I'm going to go over to this side and say, okay. So I'm just listing some items. Net income for 2018. I've already done 2017. So net income for 2018 was that. Sorry. So equal that. Other thing you want to do is not type in every number, but make references to, so that you can generalize them, or sometimes be able to drag them across and so on. So net income was that for 2018, and we're going to add depreciation. So depreciation, sorry. So you can type in depreciation, but you can also do actually just reference to this description. Equals depreciation amount will be depreciation and amortization 2018 will be that, right? So so then you add those together to get to the something called the net cash flow item. All right, so I'm going to add. So there are many ways to add it, but if you can auto sum or do sum, or you can also do alt plus auto sum. So 23,000. 23,812 dollars. Okay, sorry. So it also picked up the 2018 one. I'm gonna make sure you don't do that. All right. All right. So 20. So I was surprised why the number was different from what I expected. Anyways, so net cash flow, simple term, net income plus non-cash items. or minus non-current asset, in this case plus depreciation. All right. Okay, so now we're going to get into the calculation of free cash flow. Remember, we're going to adopt this schema, so to speak. Okay, so free cash flow is basically not net operating profit after tax minus net investment in operating capital. And operating capital can be of two types: operating working capital and operating fixed assets. So that will be the kind of the steps we're going to follow. All right, so not for an operating profit tax is the amount of profit this company will generate if they had no debt and no financial assets. So this is a profit. So we'll see, we're doing EBIT times 1 minus tax rate without subtracting interest here, because we're gonna, this is a measure, this is kind of assumes that this compares two companies as if they have no debt. Okay, just compare their operations. Okay, so the tax rate, so we're gonna need the tax rate of this company, and the tax rate of the company is given as somewhere, I think it's given as 40%. So you can make references here, and you can here, in this case, you can drag it across, and to 2018 is also 40%. So EBIT, we need EBIT times 1 minus tax rate. So EBIT of this company in 2018 was 2017 was that amount, and can drag it across for 18, and 1 minus tax rate, you can directly do the calculation here, or you can do, okay, so let me do 1 minus tax rate, so it will be 0.6. all right, so net operating profit after tax is going to be EBIT times, so 1 minus tax rate, or 60%, 125,460, and here in 2018 60,464. Okay, so we did the first part of the free cash flow. So this is the easier part. This is just a NOPAT is EBIT 1 minus tax rate. All right, the second part is kind of involving, because you have to take care of, you have to kind of calculate both net operating working capital, changes in net operating working capital, and net investment in fixed capital. Okay, so net operating working capital, we're going to calculate net operating working capital, which is the difference between operating current assets and operating current liabilities. So you must be aware of these terms: current assets, current liabilities, short-term assets, and short-term liabilities. But the operating one kind of differentiates it a little bit, because it excludes some of current assets and current liability, at least in the model of this book. Okay, so short-term investment, for example, short-term investment and notes payable, even if they are part of current assets, and this one is current liability, will not be included as in the operating current assets and liabilities. Okay, so what are the operating current assets of this company? Operating current assets of this company will include, so for example, cash and equivalents. Might be just, if I just look at the balance sheet, I don't know which one is easier to kind of make references or to type it in. All right, so current asset of this company is that. Maybe once I get used to it, it's probably it's easier to make references. Short-term investment, I'm not going to include it. Accounts receivable, all right, and inventories, those will be the items in current asset, operating current asset. And in 2017 it was 9,000 here. Accounts receivable, I have to skip a line. Accounts receivable was 315,100, and inventories were this much. All right, now operating current assets, the sum of the operating current assets is, I'm going to do out of sum, but make sure I don't add this part, 1075400. I'm just going to drag it across for 2018. In fact, starting here, I'm going to drag it across for 2018. Okay, so in 2018, current assets, operating current assets went up significantly. All right, now these are the money in current asset, but part of some of these will be financed by current liabilities, because we also kind of buy stuff on credit. That results in an increase in the current liabilities. So there, for this company, it was, all right, so current operating current liabilities would be, for example, so what are the items we need? We need accounts payable, right? We need accounts payable. We don't want notes payable because that's kind of like a financing activities, not operating current asset. And accruals. I think those were the two things. Let me move it here. Okay, so in 2017, accounts payable were that much, and accruals were that much. I could drag them down, but I have to skip a line here. Then I can drag it across for 2018. It is, the sum is going to be just this time maybe just I type in sum and make sure I only include these two items. All right, so 281 for 2017 and much more, so $608,000 for 2018. Okay, now this is the operating current asset, this is the operating current liability. The difference between these two is net operating current assets, meaning this is the amount of money this company must maintain in its net current asset. This must get financed from other sources. All right, so operating current asset is that much minus operating current liability is that much for 2017. The difference between these two, that minus that is 3, where am I? Okay, one more time. That minus that is net operating working capital. Okay, and 2018 can drag them across. So after considering the current liability, this is the net amount of current asset this company needed to hold in 2017. This is the amount of current asset, net current assets this company needed to hold in 2018. Now, to calculate free cash flow, this came from the balance sheet. So this is a snapshot or the balance. For free cash flow, we are going to be interested in investment or chains. Okay, so we're gonna have to find the difference between these two numbers. Okay, in some ways. So that's why we can only calculate free cash flow for 1 year if we have information about 2 years. Okay, now, so this was the operating current operating working capital. We also need to find out the other type of capital, operating fixed capital. All right, net property, plant, and equipment. So that will give us the total net operating capital, not only net operating working capital, but net operating all kinds of capital, right? Okay, but operating is the word there. So net operating working capital was that plus net plant and equipment for 2017. We can get it from the balance sheet. All right, so which will be gross fixed asset minus cumulative depreciation, net plant and equipment, that much. That was the balance of plant and equipment in 2017. I can drag them across to 2018 to make the same number. So the sum of these two, only these two, the sum of these two is the net operating capital, right? Both working capital and long-term capital, operating capital. Right, now what do we see? Considering both both operating fixed capital and operating working capital, the total amount needed, invested in 2018 was $1.1 million, but in 2017 it was $1.1 million. 2018 it was $2.2 million and plus. That means this company made a massive amount of investment. The difference between these two will be the investment in net operating capital in 2018, right? So this is an amount of investment needed to run the business required for the business to run smoothly, right? So this will, we have to consider this difference in order to calculate the free cash flow of 2018. All right. So in order to figure out investment in total net operating capital, we need to find the difference. In 2017, it was that. In 2018, it was that. Okay. So investment in total net operating capital, remember this, we can only do for 1 year because we only have information for 2 years, right? So 2018, it was 2018 amount minus 2017 amount. So this company made an investment of $1.1 million in operating capital. Okay. Now we have pretty much all the inputs to calculate free cash flow. So free cash flow, again, is nothing but net operating profit after tax minus net investment in operating capital. All right, both working and fixed. All right, so, and we can do it only for 1 year. So in 2018, what was the NOPAT? NOPAT, we already calculated for 2018, is first thing we did, remember, NOPAT, EBIT 1 minus tax rate. NOPAT 2018 was $10,000 and minus net investment in working capital in operating capital was that much. Okay, so this is the money this company made on profits, but this is the amount of investment this company required to run it smoothly. So these difference between those two is free cash flow. You can say this is the amount of money that's available for investors to distribute. Unfortunately, this amount turns out to be a negative number. So there's not enough money. In fact, there is negative money available for investors in that year. All right. So not a very good picture for this company for this year. All right. Okay. Now there is another way. Another equivalent way of calculating free cash flow that is kind of more popular in some places, which is equivalent. Both of these methods are equivalent, but the depiction can be different. So one other way to do free cash flow will be NOPAT plus depreciation minus gross investment in fixed assets. Minus gross investment in fixed asset minus investment in net working capital. Remember, before we did net investment in fixed asset after subtracting depreciation, and we didn't add back depreciation, but they're equivalent. I will actually let you try this. All right, so you have all the information over there, so I'm sure you can do find the same answer. Okay, you'll find the same answer because they're equivalent. All right, so let's look at some of the performance measures. All right, so if we were to kind of track down what went wrong or what went right between 2017 and 18, what are the matrices? Some of the matrices we can look at. Okay, so one of the performance matrices we can look at is something called the return on invested capital. All right, so this company generated some profits. Okay, in a particular year, let's say 2017, NOPAT was operating profit. NOPAT was $125,000. Now we can do this for both years because we don't need any information about changes here. So in 2017, NOPAT was $125,000 dollars. Okay, so NOPAT is right here, right? And divide that by, so this is the amount of profit generated, and this is the amount of capital that was needed, operating capital that was needed to generate that profit. So this has to do with how profitably this company was able to utilize its operating capital. All right. So in 2017, this was just NOPAT divided by net operating working capital. So this company made 11% of operating income over its operating capital. All right, so pretty good, I would say. But what happened in 2018? All right, in 2018, NOPAT. What was the NOPAT? So NOPAT we calculated before. for 2018, 10,000, right? Operating profit is still positive, but very small. But this is the amount of operating profit is generated. But what's the operating capital it used up for this one? All right, so the net operating capital for that year, remember we calculated both of these. So this is for operating working capital, and this is like the net operating total capital was that much. Okay, so it used 2.2 millions of operating capital to generate $10,000 of operating income. Doesn't look like it's going to be a very good number. So 0.46%, very, very low number. It only made to use massive amount of asset to generate a small amount of operating profit. Okay. All right. So that was the relation between total assets. So why is this bad? Why? So it looks like we want a bigger number of NOPAT but a smaller number of net operating capital. So what's wrong with having a lot of operating capital? The problem is operating capital has to be financed by someone. So investors, debt holders, bond holders. So if they invest a lot of money to generate profits, they would want a lot of money back too, right? So you want to utilize your asset properly so that you don't have to raise a lot of money from investors. Okay, so that had to do with money on investors, money made on investors' money. Now the other matrix is operating profitability ratio, meaning given the amount of sales, how much profit you made on the sales. Okay, so this is just NOPAT divided by sales. Now the difference between NOPAT and sales is what is between NOPAT and sales? Mainly this company's operating expenses. So sales minus operating expenses minus tax will be NOPAT, right? So this has to do with how well this company could control its costs, operating costs, right? Direct and indirect cost, operating cost. So in 2017, it was 3.66%. So let's see what it was on 2018. So 2018 NOPAT. All right. I'm gonna remember the reference here. So G104, and sales of that year. Sales in 2018 was. I'm trying to save some time just by doing 2018, but still taking a lot of time. All right, sales of that year was $5.8 million. So all right, so this was the NOPAT generated from a sale of 5.8 million. So massive, just only 0.18%, less than 0.5% of operating profit ratio, which tells you this company it's not only about investment, it also is about cost control. This company was not able to control its costs well. All right, so okay, the third thing was the ratio is capital requirement ratio. Has to do with how well this company, how much capital is it needed to generate sales. So how efficiently it was able to utilize operating capital to generate sales. All right. So you want this ratio to be small because you want to make more sales from the same amount of operating capital. All right. In 2017, this ratio was, so it only needed 33 cents of operating capital per dollar of sales. But in 2018, it was net operating working capital. Okay, so we do sales was that much. All right, net operating working capital was that much. Okay, so the ratio between these two is 22.59%. Okay, is that right? What am I looking at? This number doesn't look right. So net operating working capital Oh, so not only working, sorry, I'm looking at working capital bad. All right, I'm surprised. All right. Okay, so this is, so in 2018, it was 38 cents. So we needed slightly more operating capital for the same amount of sales. So 38 cents per dollar of sales. Okay. So its efficiency in general utilizing operating capital went down. Okay. All right. The final two sets of ratio, it has to do with how much value this company added to the, and say, to the investor's wealth. Okay, so in this case, we're not going to differentiate between debt holders and stockholders yet, because we're only calculating um, value added over operating over investors' money, all the investors' money. So the idea is, yeah, the economic value added is, let's say, you can say the amount of profit the company made compared to the amount of total operating profit that the investors needed given this company's risk, right? So economic value added is, you can say, is the difference between is the net operating profit after tax minus the operating capital, because this is capital is financed by investors, times the weighted average cost of capital. So the multiplication of these two numbers, operating capital provided by the investors times the required rate of return, will give you the minimum dollar amount the investors wanted on their investments. And NOPAT will give you the dollar amount this company generated in that year. So in 2017, in fact, there was a positive number. So this company did make more in operating profit than investors would require. So it was a good year in that sense. They added economic value of 11,000 to the company. But let's see what happened in 2018. 2018, what do we have? We have operating capital of that much. Weighted average cost of capital remains at 10%. So that's our assumption in this calculation. And NOPAT is I thought I remember it. I forgot the cell reference. NOPAT was 10,464. So this company made $10,000 in operating profit in that year, but how much investors needed? See, investors have put in a lot of money, and they want 10% out of it, given this company's risk profile, both equity holders and bondholders. We either have calculated WACC already, or we will in one of the classes later on. Okay, so the economic value added was, this company was obviously negative. So NOPAT minus operating capital times weighted average cost of capital. The second part is how much the investors wanted. First part is how much the investors got in operating profit. So $215,000 negative economic value added. So the company kind of lost investors' money. All right. Okay. So far, we are only analyzing kind of internal performance measures and internal using the internal financial statement. We can also look at other way to kind of look at the performance of the company is also look at the market information. So the other measure we're going to use is something called the market value added. That is just the difference between the market value of the stock of this company's shares, how much the investors are willing to pay for its shares, compared to how much is the shareholders' equity in the balance sheet. So you can say shareholders' equity, total equity in the balance sheet is the amount of investment the shareholders originally made plus retained earnings. So this is shareholders' equity in the balance sheet. Compare that with what the value of the share is in the market, and that's the difference will be market value added, or the additional amount market is willing to pay for this company given the future. Okay, so the stock price times number of shares outstanding will give you the total market value of the equity, and subtract total common equity in the balance sheet will give you the market value added. Okay, so this company is, so we have for 2018 it's already given. In 2017 already done. You might have to do it again. 2017, the information is stock price per share is given as an additional information. In that year, stock price per share of this company was, stock was trading at $8.50, all right, per share, and there were 10,000 shares outstanding. So that will give you the market cap of this company, all right, so the total market value of the company. And in that year, the book value of equity in the balance sheet was, the value that we see in the balance sheet is the book value of equity 2017 was that much, okay, 663 and so on. I'm gonna do one more step and say, okay, so stock price times number of shares will give you the market value of the shares, all right, and this is the book value of the shares. So this, the difference between these two is the value that market has put in the above the book value in the future of the company, okay, so $186,000. So this value was higher in 2017 compared to 2018, all right. So in this one we didn't use any, except for the book value equity, we didn't use any information from the balance sheet or the performance measures. So usually what you'd expect is you'd expect the economic value added and market value added to be correlated with each other, okay. So if the company adds economic value, then it will also, hopefully the market will also add value to its stock, okay, if they're willing to pay a higher price, okay. So that's it. Those are the measures. Try to understand what they mean, try to understand how to calculate it, all right. And if I ask you to complete it and submit it, please do so. All the best.